I've got a position open right now and it's long the Australian dollar against the Swiss franc. And the reason why this trade is running and the reason why I expect more upside, it has nothing to do with the chart except the final bit, which you'll see at the end of the video. But the core idea behind the direction comes from two economic numbers and about 5 minutes of fundamental analysis organized and simplified by ChatGPT or Claude in this case. This is fundamental analysis in 2026. So I'm going to give you the exact prompt. You see it running live, you see the table that it spits out, and I'll show you how I read that table to end up generating high quality macro trade ideas. To begin this, though, you have to understand one thing. You have to understand that a currency doesn't move because the data of a certain country was good or bad. Okay, it goes a little bit deeper than that. It moves because of what the central bank is actually forced to do, whether to hike interest rates or cut interest rates. So the data goes in, the data feeds the central bank, and then what the central bank does actually moves the market. Okay, and in this there's actually expectations for what the central bank will do. Now this gets a little bit too complex and it takes a bit to explain everything. So if you want to understand more and dive more into this, you can actually see the full videos, full educational videos that I've made around this topic. So when you understand the real fundamental analysis, then the question stops becoming, what every single data point from a country is actually doing, which is not answerable, okay? You can't decide whether a currency is bullish or bearish by looking at every single data point from that currency pair, okay, from that economy. Because you will have to look at PMIs, you have to look at retail sales, you'll have to look at GDP, you will have to look at CPI, inflation, you would have to look at the housing market, you would have to look at labor market. Now, all of these, it's a lot of stuff. And 80% of this stuff does not matter for what you're actually trying to do, which is take trades, take profitable trades. We're not trying to become economists. We're not trying to be, analysts. We're traders. We want to actually focus on the data that allows us to understand where a currency is most likely going to move. Okay? So the point of the data starts to get a lot simpler when you understand how fundamental analysis actually works. And again, if you want to dive deeper, got full videos, full educational videos on that. But for this particular video, I want you to fully focus on the framework that I'm about to show you. So when you understand the real fundamental analysis, then the question stops being what is every single data point in a country actually doing, which again, you cannot answer. You can answer, but it's not actually practical. It doesn't actually give you a real edge in making a trade. So that question should become which data actually is forcing the central bank to do something. So whether to hike or to cut interest rates. Now this simplifies everything a lot because the central bank, it's not sitting there acting random and it's not sitting there analyzing every single data point from a country. The central bank looks at two things. They look at inflation and labor market. They've got a legal mandate, okay? They have a legal description of what to do. And it's 95% of the case for every central bank is keeping inflation stable, so not too low but not too high, and keeping the labor market supported, okay? This is the framework. This is fundamental analysis. This is what I want you to focus on, and this is the base, the understanding that allows us to build a framework to generate high quality trade ideas, which I'm about to show you. Okay, let's get practical, because getting this context from 10 economies, all the G10 currencies, inflation, where it sits with the target of the central bank, the labor market, what the central bank actually said about the labor market, used to take a lot of time, okay? Hours into the weekends, notes everywhere, tabs, spreadsheets with a lot of data. But now it's actually just one prompt and 5 minutes with ChatGPT, with Claude, with whatever AI you want to use. But it only works if you ask this correctly, okay? So first of all, you have to make sure that you're using one of the latest models, whatever you want, and it's actually a model that has web access because you want up-to-date information. If the knowledge gets cut off, the data obviously is going to get cut off as well, and you're going to get hallucinations from the AI. So make sure you're using one of the latest models, the models that actually think. So for instance, if you go to ChatGPT, you'll see that you can actually adjust the model and obviously adjust also the thinking effort. You can use medium, you can use high, and the same goes to Claude as well. You can use one of the latest models and you can actually adjust the thinking. Now, you don't need an extra or max. Just use one of the latest models at medium or high, and it's going to be pretty accurate. So the prompt is essentially this: act as an institutional macroeconomist, pull the latest core CPI, inflation, and the labor market data for the G10 currencies over the past 3 months. I'm going to explain why this matters so much in a second. Summarize which economies are strengthening, inflation moving up and away from the central bank's target, labor market solid, and which are weakening. Create a usable and simple table. The data is only useful in context with what the central bank's targets and projections are. So contextualize the numbers. All this said, let me actually walk you through what this whole means. Act as an institutional macroeconomist. Here we're simply priming. I don't know exactly if this is gonna do something, but it's free. You can just add it. It doesn't cost anything, so I'll just say it. The next important bit is over the past 3 months. This one matters because when you actually try to think like a central bank, to understand what actually the central bank is most likely going to do next, you should understand that the central bank doesn't move just on one single print. One print can be noise, and they will happily look through that noise and ignore it if it's just one data print. Central banks move on the trend of the data, okay? So if the data is moving in a certain direction or in another direction compared to what they target and what they expected. So we want to see the 3 months evolution of the data. What was inflation 3 months ago versus what it is right now, how it has moved over these 3 months. Is it trending towards the target or away from the target? Now that's all context that is going to tell us if a central bank needs to be dovish or hawkish. And in fact, the other important point is from the central bank's target. So we're giving it the context in which it has to take into account the data, okay? Data for the sake of data is not useful. So inflation on its own, it's not a meaningful number. 2%, for instance, in Switzerland is hot, and in Australia instead is cold. It's completely different targets between the two central banks. The Swiss National Bank has a certain inflation target, and the Reserve Bank of Australia has another inflation target. Understand what I'm going here? The point is from the central bank's target, okay? What matters is what the central bank actually cares about, okay? A central banks may want to target 5% inflation, whatever, okay? And then a country could have 6% inflation and the central bank could be dovish. Obviously, it's an example. It's not like that, but you get the point. And then again, it's basically the same thing. Contextualize the numbers. I repeat it here deliberately at the end of the prompt because it's very important. We don't care about data just for the sake of data. We care about the data relative to what the central bank is expecting. If they thought the labor market would weaken and instead it strengthened, well, that's a signal, okay? That's a signal that the central bank is going to take into account and is going to lead them to be more hawkish. If they're targeting, they're expecting 2% inflation in the next month and instead it prints 3%, well, that's a signal, okay? It's the number put into context with what the central banks expects, okay? Context, it's a keyword. All this said, just hit enter and send the prompt. Roughly in 5 minutes, this is gonna go all the way. It's gonna search everything on the web to find all the data we need. Now, things that would have taken hours of research, hours of managing a spreadsheet with everything, it goes and it finds everything we need in minutes. Now, this is the magic and power of AI. And based on the prompt we gave it, it's not just going to spit out just the data for the sake of data. No, it's going to put the data into context based on what the central bank's target, what the projections are, and so on and so forth. Everything we designed the prompt to do. And by the way, you can still, you can improve this prompt as much as you want. This is a starting point. It works pretty great. I use this prompt right here. But again, you can improve it on this if you want. You can add things, you can tweak it, do whatever you want. But this as well, in and of itself, is already pretty fine. So as you can see, It's analyzing Switzerland, it's analyzing Sweden, Norway, Reserve Bank of New Zealand, RBA, the New Zealand CPI for the quarter, for the second quarter, the unemployment rate, Australia trimmed mean CPI. See, it also understands that it doesn't have to focus on headline CPI, because if you understand how our central banks operate, you understand that it's core CPI that actually the central banks target. And for Australia, for instance, it's trimmed mean. So Claude in this case, but also ChatGPT, they're very smart in understanding, based on the prompt that we gave them, what actually matters for the central bank. So it's not going to focus on the data that actually doesn't move the needle. Now, while Claude actually runs, I'm going to run the same exact prompt on ChatGPT. So we can actually compare the two, because I've never done this actually. We can compare the two and look at who organizes things better. Okay, let's see. And while the research runs, I actually want to show you something, because I care a lot about making sure that you understand and you know that you're not wasting your time in learning these concepts, because there's plenty enough of traders out there who tell you what to do in trading, tell you what you should learn, how you should move, how you should trade, without actually showing that that actually works. I do things differently. I have a verified myfxbook, which you can analyze as much as you want. It trades exactly this type of framework. This gain is achieved with about a 0.25 to 0.5% max risk per trade. So notice, for instance, the drawdown, the max drawdown to profit ratio. If you risk 1% instead of 0.5, you're gonna 2x this gain already. If you risk 2%, you're gonna 4x this gain already. And this is just to prove consistency, okay? 2 years of consistent uptrend in the equity, just applying these concepts that I tell you and then I teach you about here on YouTube for free, by the way. So make sure to like and subscribe if you enjoy this type of content. Okay, both are done. Both Claude and ChatGPT are done. And I've actually realized that ChatGPT is a lot better at this. I'm not sure if it's just a little random, but for this example, I'm going to go with ChatGPT. Now, as you can see here, ChatGPT gave us a nice clean table that we can start reading through. And in this table, I want you to look for something in particular. Extremes in how the labor market is moving in one country and inflation moving in one country versus another country. So we want to look for a country that is being pushed towards a more hawkish direction. So central bank that is most likely going to hike interest rates or keep interest rates high, versus another central bank, another country in which inflation is moving lower, the labor market may be softening, and so the central bank is incentivized to keep interest rates low or maybe even cut interest rates. That is the whole mechanism around here, okay? And we can start looking at, for instance, Australia already. Now, Australia has trimmed mean CPI, which, as explained to you, is essentially core CPI for Australia, and it's the central bank focus. So we have trimmed mean in past 3 months, going from 3.4% to 3.6%, and then the latest still sticking at 3.6%. Essentially, inflation is elevated because the central banks, their ABA in this case, targets, as ChatGPT says here very nicely, RBA targets 2 to 3%, midpoint 2.5%. So 3.6% trimmed mean reflects inflation essentially pretty high and still running above 3% until around mid-2027. Essentially, strong hawkish because they have inflation above target and the labor market doing pretty well, doing okay, because look at the unemployment rate, 4.4, 4.5, 4.4, and 4.4. So it's not weakening, it's not collapsing, it's okay, it's stable. So we're starting already to establish that Australia is a hawkish central bank, a country that is being pushed towards potentially higher interest rates because inflation is hot and the labor market is okay. Now, I'm not going to read through every single country here. You can do that on your own. What I want you to point at is the divergence, which I'm already aware of. It's Australia versus who? Switzerland. Because Switzerland has core CPI around 0.3%. Now, this is year-on-year number, okay? This is the yearly number. It's not monthly number. It's the core CPI year-on-year number, 0.3%. Essentially flat at very low levels, as ChatGPT says pretty well. And the unemployment rate is 3% versus 2.9% in June, so ticking out a little bit. Now, the Swiss National Bank defines price stability as inflation below 2% while avoiding deflation. Now, 0.3% is almost negative inflation, so deflation. Essentially, Switzerland is in low inflation, soft inflation, virtually no domestic inflation pressures from this lens, which means the SNB, the Swiss National Bank, can keep interest rates at zero for as much as they want, as long as inflation is not a problem. Now, on the contrary, we have Australia, where interest rates are already 4 and potentially they're gonna go higher. But in any case, even if they don't go higher, they're still gonna stay high. So we got, and this is the core of FX trends, we got one country, Switzerland, with 0% inflation pretty much and zero interest rate. And then we have Australia with 3.6%, so above the Reserve Bank of Australia target, and 4.25% or so interest rate. This makes the Australian dollar against the Swiss franc interesting from an interest rate divergence perspective, from a monetary policy divergence perspective. And this is in fact exactly what has driven all of this trend, because in here, now I'm not going to point out exactly in which dates because I will have to look that up, but in here, what happened? The Reserve Bank of Australia hiked interest rates while Switzerland actually kept interest rates low at 0%. And this made the Australian dollar against the Swiss franc more attractive. First of all, because it's a carry trade, it's a positive carry trade, but also because speculators tend to look for these divergences in which one country, one central bank is moving towards a hawkish direction and another central bank is moving towards a dovish direction. This creates one of the best trends that you can actually trade in Forex. So as I've explained, for instance, on X, these are in fact the best macro trends. High rates with central bank ready to hike the Australian dollar, low rates with central bank wanting to stay low the Swiss franc. Equals best positive swap in the G10, and that's true because you get a 4.25% annualized interest rate, essentially, interest paid, and a nice macro trend because speculators actually load into this carry trade and this moves the currency pair higher. And as you can see here, in fact, I've gone into a bit more detail. This was in May 9, where I've laid out all the reason behind this trend, which was the RBA hinting at rate hikes back in December 2025, bullish for the Australian dollar. The RBA hiking interest rates in February, hiking again in March, hiking again in May. And this is, in fact, the trend that is unfolding right now, continuing. Why is it continuing? Because as we've seen, what's happening is that Australia still has high inflation, still a labor market that is solid, which means the Reserve Bank of Australia can stay hawkish, potentially hiking interest rates once more, but at least keeping interest rates high. Versus who? Versus Switzerland, which has deflationary pressures, unemployment stable but ticking higher a little bit, and in any case, a Swiss National Bank that is not going to hike anytime soon, potentially even they might cut interest rates at some point. And that's how the Australian dollar against the Swiss franc ended up on my watch list and ended up being a long position. Now, in just like that, in the 5 minutes of less, you have done with ChatGPT a solid fundamental analysis for every currency in the G10. It does not get simpler than this. You just have to understand exactly what's going on behind these numbers and why these numbers actually matter for the currency. If you want to go deeper in this, you can watch our educational videos, which go as deep as you want, and they're completely free. You just have to put on a little bit of time to actually understand what's going on. High inflation versus low inflation on the Swiss National Bank, solid labor market, hawkish versus dovish. This creates these type of trends, and that's to tell you that this trend is most likely going to continue. But listen carefully here, because this is the part where people take everything I've just shown them and they end up getting eaten by the market anyway. The table and method and framework that I've just showed you gives you direction, tells you where things are most likely going to trend to. Perfect. But that's all it gives you. It does not give you the exact timing to enter the trade in the macro direction. Because here's the groundbreaking news for you. The market doesn't move in a straight line. And what happens if you long right here? Well, you get stopped out right before the market actually moves in your expected direction. And I'm sure you know that. It's one of the main problems traders have. They can understand the direction, but then they end up missing the timing. So direction and timing are two different things. You can know exactly where something is going to trend to, and you can still end up getting stopped out at the wrong time before the market proves you right. So the wrong timing can get you stopped out in a simple technical pullback. A very simple technical pullback, which is what? A corrective structure, from which the breakout then gives you another opportunity to actually position long. The pullback itself does not change the macro thesis behind the trade. A pullback does not change the context, does not change one thing about the macro story. In this context right here, the divergence was still there. The market was just building itself, preparing for the next leg higher. This happens. The market has to breathe, the market has to recalibrate itself a little bit, recharge, and then move for the next leg. So the sequence and logic that I want you to understand is that the macro tells you the direction and the technicals tells you the timing, okay? So what technicals should you use? Listen, anything, really anything. You don't need me to teach you about technical analysis. There's plenty of content out there that you can watch about technical analysis, endless. But I will tell you, the simpler you keep it, the better it is. In this case, for instance, if you actually notice, this entry trigger right here, it's what? A simple technical retest. It's a simple break, retest, break of the consolidation to the upside, obviously. Resistance that turned into support, structural retest, and then go. The simpler you keep it with your technicals, the better. As long as you align your technical entries with the fundamental direction, you're making your trading as simple as it gets. And before I let you go, always remember, this type of analysis, what we just made here with ChatGPT and everything, is not a forever direction, so to speak. This snapshot that we took here with ChatGPT is not something that goes on for 6 months, 12 months, okay? Data here can change. Every week, there's new data. Every month, central bank may do something else, and so on and so forth. So what you have to understand is that we've established the view. The reasons for the direction are clear. And when you understand the reasons for the direction, you also understand what can change that direction, okay? If you just watch me build in real time the macro idea behind the Australian dollar against the Swiss franc going further higher. The same logic that has brought it all the way up here is going most likely to continue because the Reserve Bank of Australia is going to keep interest rates high versus the Swiss franc. So the Swiss National Bank is going to keep interest rates low. Okay, as long as that's true, as long as that divergence is true, and as long as the Australian dollar is going to get that push from higher interest rates, not just the fact that interest rates are high, but the fact that they are expected to stay high and potentially expected to go even higher, that creates this type of trend, okay? But that's context, and context can change because if inflation from Australia, for instance, starts to print back into the central bank's target, well, the central bank is not going to need to be hawkish anymore. If the unemployment rate actually decides to start weakening, well, the Reserve Bank of Australia is not going to need to stay hawkish anymore. They're gonna maybe have to support the labor market. So you have to understand things here. We understand the context is this: inflation, labor market for Australia, and inflation, labor market for Switzerland. The Reserve Bank of Australia is going to need to keep interest rates high. Switzerland is going to need to keep interest rates low. As long as that's true, the trend continues. But as soon as there's something that threatens that fundamental pillar behind the view, well, things change. I want you to understand that because I see traders start to get married with a view, obviously. They get married with the idea that, oh, Australia is going to keep interest rates high forever, while Switzerland is going to keep interest rates low forever. Well, maybe not. Maybe next month, inflation is going to print 3% in Australia, and things are going to look extremely different, okay? So the day, for instance, Australian inflation drops back into the target band or the labor market weakens, things are going to change. And the reason to be long the Australian dollar against the Swiss franc is not going to be true anymore. Understand what I'm saying here? It's data point, and exactly the data point that matters for the central bank. So the trade lasts and goes on for as long as the data that builds the view, so what? Labor market, and inflation. As long as this continues to support this divergence, the trade and the direction can continue. Obviously with pullbacks. Always remember, there's going to be pullbacks in the trend. That's something you cannot avoid. So you have to be timing things. I would not suggest to enter long right here. I would suggest to potentially enter long on a pullback. So you have to keep continuing monitoring the labor market and inflation context for the two currencies that you actually are analyzing, in this case, the Australian dollar against the Swiss franc. But whatever it is, you have to keep that watch list updated. So every week or after every important data point, you run this prompt again, not hunting for new trades essentially, but just to keep in check whether inflation in Australia is still high and moving higher, the labor market is still solid, inflation in Switzerland, and so on and so forth. Okay, I don't want to bore you for too long. This video has gone quite long already, but it's quite an important video. And if you take the time to fully understand this, you're gonna see the consistency that you saw in the myfxbook account earlier. So let me summarize as much as possible. First thing you do is run the prompt on ChatGPT. Okay, I've noticed that it gives slightly better results than Claude. Once you have the table, what do? You look for extremes. One country in which inflation and the labor market is moving in a certain direction, prompting the central bank to be hawkish, versus a country in which the labor market and inflation is moving in the opposite direction, prompting the central bank to be dovish. Okay, we're pairing dovish versus hawkish essentially. If you want to simplify it as much as possible, is this: hawkish versus dovish. But how? By understanding the data that actually matters for the central bank. So inflation and the labor market. We're not just looking at everything. We're not just looking at the central bank's communication, even though that's actually important, but we're mostly putting our thoughts into the central bank's view, understanding who's going to be hawkish and who's going to be dovish. And then that extreme gives us a strong macro bias, like in this case. So once you have a macro bias, once you have a hawkish versus dovish divergent central bank, well, what do? You look for the timing, okay? You start looking for the technical timing to position in the macro direction. You don't just long at any market price. You look for the moment that the chart tells you, hey, you gotta enter right now. This is the perfect timing, okay? And 5, you just monitor the thing, okay? You don't just monitor the chart because the chart can fool you. The chart can trigger you to think that things that have actually changed. For instance, if you're looking at a chart right here, it may look like things are starting to round up and potentially this could go lower. But if you understand the context, if you understand that the Australian dollar is being supported by a hawkish central bank, while the Swiss franc is being weakened by a dovish central bank, while you ignore this, you know it's a technical pullback, and then you expect things to keep moving higher. That's the whole system. One single prompt, one single framework to get anytime you want the complete picture on every currency you want and to find the best macro divergences out there. It's a little bit more work than dragging an indicator onto a chart, I know that, but it's a lot more rewarding. The trends that you end up finding, the opportunities that you end up finding are completely different species from what you find from indicators, okay? You're not reacting just to the chart, you're actually sitting there, understanding the drivers behind the trend, the drivers that are actually moving price, and then positioning with it. So go on, run the prompt right now, and if you have any questions, drop them in the comments below. I read every single reply